In this video, I'm going over Archego Capital. They recently had a margin call on their $20 billion position that was heavily leveraged. They were going through multiple different banks and not telling those banks about how much their leverage was with each bank. So the different banks didn't know about the different sources of leverage. And it got to the point where they were leveraged up to 8-1. And they weren't very diversified, mostly in heavy in Discovery, Viacom, and Tencent Music. And then when it sold off, the Goldman Sachs was the first one to put on a margin call to protect themselves from the money that they lent out to Archego Capital, and Morgan Stanley quickly followed. But there were some that didn't quite get out in time, and mostly because of their risk tolerance as far as, well, the risk management for Nomura and Credit Suisse. They ended up losing quite a bit of money. And you can see on this chart, Nomura went down about 20%. And this ended up causing a lot of banks to decrease in value as far as their stocks are concerned. But small hedge funds like Archego Capital aren't enough to bring down the whole system. It's not going to be a domino effect as far as we can tell. But that doesn't mean there's not other hedge funds that are highly leveraged. I was able to find Chicago-based Citadel. They had 8.8% leverage. Now, this could be a potential hedge fund that could be in danger in the future if ever there's a sell-off. They seem to have a fair amount of holdings, at least in the 10% range, with Tesla and Amazon. They have puts and calls regarding those two. But what has occurred could end up causing stricter maintenance call requirements. So the maintenance call requirements might end up being somewhat similar to Goldman Sachs. I know M1 Finance, they do maintenance calls once your portfolio drops above 30%. But it is important to recognize that it's not only hedge funds that can bring about extra leverage using multiple different sources. Individuals are able to do this as well. And you can technically go to E-Trade, Charles Schwab, TD Ameritrade, Fidelity, and apply for leverage on those different sources and possibly get up to your neck in leverage. And if things sell off just slightly, it could potentially trigger a margin call. So if enough people as individuals are set up in such a heavily leveraged position in current day, that could end up having a drastic increase in the momentum of a sell-off when one does occur, as some people suspect a correction will come. Right now, there seems to be a lack of communication between the different banks, and I think regulations might end up changing that. But hopefully there is regulations to prevent this type of leverage to come about in the future, because there is ways of getting around it using different banks and using swaps. So we really need to get regulations set up so that this doesn't happen again, because if enough large hedge funds over leverage themselves like this could have major drastic effects for the economy when a sell-off does occur, because it would just build major momentum for a sell-off. So thanks for tuning in. Appreciate it. Y'all have a good one. Later.